Hello, everyone. Welcome to this stream where we're going to take a look at the earnings expectations and the actual earnings in about 20 minutes for Meta Platforms, Alphabet, Microsoft, and Amazon. I don't think I've ever seen all four of these companies announce on the same day, so this is going to be a busy few minutes after all those earnings are released. See if I can get this changed to screen there. I went too far. What I'm expecting is that Amazon will be the first to report at around 4:01, and then Google will be about 2 minutes later. Meta and Microsoft are both scheduled at 5 minutes after the hour. But I have pulled some information together that I want to share with you, basically to set some expectations for what we'll be looking for in these earnings reports. I was listening to a podcast this morning, so I'm going to share a little bit about what some of the analysts were looking. So I pulled this together for the Tuesday close. This was yesterday's closed. And three of the names closed down. Microsoft was the only one to close up yesterday. And they were all below average volume. So we don't have a lot of committed buyers at the moment. We have three of the names that are up year to date, Amazon being the best at 12.51 year to date. Google is 10.74. Meta at the close yesterday was just barely above the green line, and Microsoft is still what we would call correction territory at the moment. And if you look at where Microsoft sits relative to their most recent 52-week high, they're actually in bearish territory. Meta, related to their 52-week high, is in correction territory, and then Amazon and Google are doing the best at the moment. We'll take a look at their charts, but if I were to summarize where each of them are sitting, Amazon is in an accumulation phase, so it appears that institutional buyers are picking up shares at this moment. The bias, however, is bearish, and I'll explain what that is when we look at the charts. Google is in an uptrend, and they have a bullish bias. And then Meta and Microsoft are both in what we would call consolidation, and they both have a bearish bias. So I was listening to a podcast this morning, and they fact set, and they summarized that the AI demand trends and capital expenditures are the primary focus area for investors. Let me switch this to a bigger screen. On AI demand, UBS noted that GPU and CPU demand is inflecting at an unprecedented pace, though investor expectations are particularly elevated for both AWS and Google. KeyBank highlighted the AWS chip revenue exceeding $20 billion. That is up triple digits year over year. And I had seen another indication that that could be about a $50 billion business if it was actually standalone at the moment. So anyway, it's suggesting upward CapEx bias into next year, while returns on CapEx remain attractive. And Melius Research sees upside risk to Alphabet's reiterated CapEx targets, giving accelerated token consumption and cloud compute demand. And previews on Microsoft were somewhat mixed. Guggenheim is flagging downside risk for Azure, given a high growth bar of approximately 38%. And we'll talk a little bit more about that later. but we'll want to keep an eye on that Azure growth to see if they're actually able to convert some of this CapEx to actual revenue. Piper Sandler was a bit more constructive on Copilot monetization and OpenAI and Anthropic exposure. And then finally on Meta, BMO raised concerns around CapEx without clear near-term revenue visibility, while Guggenheim argued AI investments are already generating high return opportunities. So they are using that in their advertising space to get more advertising revenue. So it depends on how that all goes, on how Meta and investors are going to react to that. We can look at some of the individual companies. I think Amazon reports first. I think we probably all knew what Amazon does, but I'll put this on the screen so you can see it pretty well. So they have the primary competitors of Microsoft in the cloud, Google and Oracle. In the retail space, they have Walmart, PDD, Alibaba. And for advertising, they're competing against Meta and Google. They did announce their partnership with Anthropic, expanding that on April the 20th. That is pretty bullish news and a major price driver. They have announced Alexa Plus International. They rolled out the generative AI assistant to Italy and Spain. That was on the 15th. That wasn't a major driver. This was a driver where the CEO highlighted the cost to server focus, the $200 billion AI investment, and the money that they're making on their GPUs. Then their last earnings, they basically disappointed on the profit outlook. The stock initially fell 17% before moving into a recovery. So they have a $200 billion CapEx plan. They have that $15 billion AI revenue run rate. It's closer to almost 20 or 20 billion is the custom silicon business. And this could be 50 billion if it were a standalone company. Then they're looking at expanding their low Earth orbit satellites. They have a launch window set for mid 2026. They're targeting 1,600 satellites by July of 2026. They currently have 241. So that's an aggressive target, it looks like. They've already established some partnerships with Delta, NASA, AT&T, and Vodafone. Okay. They have a implied move of 7.5%. So that's something we'll want to be watchful for. They have a pretty low short interest. So I don't think that's going to play into the initial market reaction to their earnings. And then I pulled some metrics from Amazon. I did create a video specifically for Amazon where I go over all of this in detail. But basically, they're trading below their 5-year average PE, but they are priced higher than the sector overall. They are growing their revenue faster than the sector, slightly lower than their 5-year average. They're growing their EPS at 20%, a little bit above their 5-year average and quite a bit above the sector overall. And their net margins are better than their 5-year average and the sector, which is at 4.01. If we take a quick look at Google, you know what they do. They're basically the world's digital organizer of information on how to get to various information sources around the world. They are a content and global titan. They operate YouTube, the world's largest video video platform, and Google Cloud. They do have the AI engine, which I think Gemini has been improving very rapidly, and they're expanding stuff almost faster than I can learn it at the moment. But it provides artificial intelligence capabilities that powers everything from consumer smartphones to corporate data centers. They are a global conglomerate in the interactive media and services industry. They have Google Search, YouTube. They own the Android and the Google Cloud. They compete against Microsoft, Amazon, Meta, and Apple. The notable metrics include a market cap that is exceeding 4 trillion and a massive 2026 capex budget. And it's these budgets, these capex budgets, that really drove the prices down from October of 2025 onward. The market really wants to see a shift from this capex deployment for this AI into actual revenue for these companies. So this is affecting all of these companies. So we can take a look at their key metrics. I did not do a video on this one. This is the only one of the 5 mega caps, mega techs that I did not produce a video on. But they have a forward PE of 29. Their 5-year average is 23, much better than the sector. They are growing their revenue above their 5-year average, much better than the sector. EPS is at 18%, slightly lower than their 5-year average, but better than the sector. And they're much more profitable than the sector at a 32% net margin, and that's better than their 26 5-year average. So they have an implied move of 7.5, similar to what we saw before, and they also have a very low short interest. Then we'll take a look at Meta. They are in the interactive media and services business. They compete against Google and Amazon, Snap, and TikTok. They do boast good gross margins at 82%, and they generated over 100 billion in EBITDA in the trailing 12 months. They did announce a 10% reduction in force and elimination of 6,000 open roles. I think that came to about 14,000 altogether. These open roles are not actual people. It was just positions that they had open. They're just not going to fill those. They did sign a deal for 1 gigawatt of solar energy via space-based satellite tech. I haven't investigated that very much. These kinds of companies are always under enforcement regulations, so they have a risk of 10% fines in global turnover. And once again, we had the price mover of the capex, because the size of this capex really drove the prices down after October. So they are expecting revenue growth. Their revenue is expected to be 55.4 billion. There was an e-marketer group that did some research and said Meta is projected to surpass Google as the #1 global digital advertising seller this year, or by the end of this year. Analysts are giving them an $855 median price target. You can see their revenue estimates here, their ad revenue, and their earnings per share. They do have that CapEx, 135 billion. They are going through their reorganization, and they did announce a strategic partnership with Amazon where they're deploying tens of millions of the Graviton cores to optimize the AI workload. They also have an implied move of 7.5%. This is based on the options market. So basically, I just go out to the options chain for the options that expire nearest to when they're announcing their earnings, and I'm looking at what the market is pricing for an implied move. They have a slightly higher short interest at 1.2, but that's still pretty negligible. I don't really see any concerns until you get somewhere above probably 5 for these big companies and 10 for most other companies. Then we look at their key metrics. They have a forward PE that's pretty much in line with their 5-year average, but better than the sector. Their growth is better than their 5-year average and much better than the sector. We just need to keep in mind this sector includes companies like AT&T and Verizon that don't grow their revenues very fast, so it's kind of a hard compare. Their EPS growth is about 13%. That's a little less, actually quite a bit less than their 5-year average, and even less than the sector overall. When we turn to profitability, they have a 30% net margin, pretty much in line with their 5-year average and much better than the sector overall. So we're starting to get pretty close to when the announcements will be made. So I'll quickly go through Microsoft as well. I had a lot more information. You can always go and look at the video that I put out because I cover this all in detail. Get a drink here. So Microsoft is at a critical juncture. They're trading near valuations that we haven't really seen in the past decade. As of today, the market is laser focused on one thing, whether the massive capital expenditures and AI infrastructure are finally translating into revenue growth. So they're a digital utility. They provide the foundational software for office work, Office 365. They provide operating systems and the cloud infrastructure under Azure. And they are also an AI brain for the enterprise. And through its multi-billion-dollar OpenAI partnership, it's integrating co-pilots and agents into every product, allowing businesses to automate complex workflows. I'm going to skip some of this other information because we're starting to run out of time here. They have an implied move of 6.7, so it's actually the smallest of the 4 that we've looked at so far, but they do have a short interest that's above 1%. When we look at their key metrics, they have a PE of 25.68, below their 5-year average, and they're pretty much in line with their sector. The revenue growth is 15.63, slightly above their 5-year average and above the sector. Their EPS growth is 17%, couple hundred basis points above their 5-year average and above the sector. And their net margins are 39% compared to the 5-year average at 36 and the sector at 5.3. I would love to cover some of this other information, but I think we're starting to run out of time here. So I was looking at the market. We still haven't closed. We have about a minute to go, I think. Well, maybe 5 seconds. But it looks like all 3 of the major indexes are going to close down. We only have three of the sectors that are in the green, energy being number one. I haven't looked at oil prices today, but I bet that they are up quite a bit. Technology did perform overall perform very well, and financials managed to squeak out a small gain today. I was looking at just the four charts that we're going to look at today, and I didn't see any big changes there, but I'm glad to see technology is leading. So the earnings should be dropping here shortly. I'll wait till they show up in Seeking Alpha before I try to get to them. So in the meantime, we'll go and maybe look at some charts. We'll take a look at Microsoft. You can see this big, huge sell-off that they had when they announced their CapEx and the concerns about revenue um, increasing as a result of that CapEx, then the concerns around that. So we did see a big, huge drop off in their prices. I think they were down, let's see, to their bottom from the top, they were down a total of 34%. They are getting close to this support resistance line that I see here. That's been tested several times. They did break down below that on about January the 29th, was at their last earnings call. They did, after making an announcement about opening up a data center a little bit early, they did get about a 19% boost back to their current prices. They still are going to find some resistance at this long-term support resistance. We also have a 200-day that's up right here, and it's going to sit right around where this resistance line is. They do have an RSI that is bullish. They have a PPO that is bullish in the weekly or in the daily view. Okay, I don't see any of these reporting just yet. I'm sure they probably are because it's a couple minutes after now. Okay, so let's go to Amazon. We'll look at the 1.5 year chart. Oh, by the way, on Microsoft, they have sold off the last 3 or 4 times that they've announced. So that's always something we're going to have to keep in mind with these companies. Even when they provide solid results, there's other things that may scare the investors and drive the price lower. So we'll go take a look at Amazon real quick. They also had a pretty big drop on a few of their earnings recently, but they have recovered quite well. They've broken two previous resistance lines, actually three, and they're making pretty good headway. Looks like today they opened lower, but they actually closed higher. They're above an upward sloping 5-day moving average, an upward sloping 21-day that crossed the 200-day on the 15th of April, and it crossed a downward sloping 50-day moving average on the 10th, but that 50-day has bottomed out and is now moving higher. Once we get the 50-day crossing above the 200-day, then we will have what they call a golden cross. Amazon is very overbought at the moment. They have an RSI that's above 75. They also have a PPO that's about as high as I've seen it over this last year and a half. We got a bullish crossover and bearish territory on the 30th of March, and they have accelerated about 31% in less than a month. So they have done very well. Let's go take a look and see if we have announcements. Microsoft did report, so I guess we'll take a look at them first. Then we'll go and look at the other charts for the other companies. So they did beat their EPS by 22%. They did beat their revenue by 1.46. Cloud revenue was 54.1. That increased 29%. The intelligent cloud was 34.7 and increased 30%. So if we were looking for 38, I think this is a bit shy, and that may drive Microsoft lower in the after hours. Let's go take a look. Nope, they're actually going up. So they're up 0.5% after. So that's a bit surprising to me. I would have I got to close this tab because I keep clicking on that one first. I would have thought that with the market looking for 38, that this would have really driven that price down in the after hours. Okay, let's go see what else we're seeing here. Do we have any other ones? We have Amazon that's reported now. So we'll take a look at them. While that's loading, I'll pull up the Amazon chart real quick. Looks like they're down about 0.75%. So they beat by $1.13. Their estimate was 278. The revenue was 181.52. They beat that by 4.3 billion. North American segment sales, that's their retail, increased 12% year over year. International increased 19%, and AWS increased 28% year over year to 37.6 billion. Let me see what they're doing once more real quick here. Okay, so they're hanging in there about 0.75%. Net sales are expected to be between 194 and 199 versus 188. So it looks like they are increasing their guidance, and growth between 16 and 19% compared with the second quarter 2025. Operating income is expected to be between 20 billion and 24 billion, and that's compared with 19.2 billion last year. So they are still down in the after hours. So we got Amazon, we have Alphabet now. So they beat by $2.44. They had revenue of 109. They beat by 2.87 billion. That's up 21.8 year over year. The company announced a 5% increase in the dividend. So the quarterly dividend will be now 22 cents. Hey, Shadow Guy, good to have you here. Russ, I'm glad to have you here as well. Consolidated Alphabet revenue, 22%, 19% in constant currency to 109 billion. Strong performance across their business, the 11th consecutive quarter of double-digit growth. Google services increased 16% to 89.6 billion, led by 19% growth in their Google search and another 19% in their Google subscriptions. They have me as a subscriber now. Platforms and devices, an 11% in YouTube ads, which I pay the premium, so I don't have to pay any attention to those ads. Google Cloud saw a meaningful acceleration in growth as revenues increased 63% to 20 billion, led by an increase in the global cloud platform. So their shares look to be up about 4% in the after hour. Whoop. Gotta get my fat fingers on the right keys here. Sure enough, they are up $12. I expected them and Amazon to actually perform the best. So I'm glad to see that Google is rising in the after hours. It looks like they had a pretty good report. Okay, now we're turning our attention to Meta at some point here. Unless I missed it. Nope, there it is. I missed it. So let's take a look at what Meta's doing. I'll go to the chart and take a look. So we're looking at Meta now. Ooh, wow, that's painful right there, guys and girls. Down 40 bucks. Okay, let's go see what the report said. They did beat on EPS by 378. They beat on revenue 3.56 billion on average daily active people. That's kind of amazing. An increase of 4% year over year, a slight decline in daily active people on a quarter over quarter basis. Was driven by internet disruptions in Iran, as well as a restriction on access to WhatsApp in Russia. The ad impressions delivered across our family of apps increased 19% year over year. Average price per ad increased 12%. We expect second quarter revenue to be in the range of 58 to 61 versus the consensus. So that's kind of in the midpoint. Our guidance assumes foreign currency is approximately 2% tailwind year over year total revenue growth based on current exchange rates. We expect our full year total expenses to be in the range of $162 billion, unchanged from our prior outlook. That's probably why they're down. I think the market was actually expecting maybe a bit of a reduction in their AI spend, and it looks like they're holding hard on that revenue or the capex for this year. So it looks like we'll have to wait till next quarter to see any improvement in their revenue projections based on that spend that they're making. So they are performing the worst. So, yep, CapEx is killing them, Mike. Shadow Guy says, Daryl, thanks for contributing to their dividend since I subscribe and I subscribe to the YouTube Premium as well. I'm a subscriber on Gemini. Let's see. We have a comment here. Qualcomm record automotive growth. Okay, somebody took. Okay. And then, yeah, the CapEx is killing them. That's for sure. Anderson, good to see you here. Appreciate having you. I'm missing Victor because he knows this particular platform here much better than I do. So I'm going to go back to some charts. We were talking about Amazon. They've done pretty well. Let's look at Meta. So they've been struggling ever since they, announced their CapEx costs for 2026. Once they announced those plans, they really fell off. They did find a little bit of support here, but then dropped again in late March, early February. They did bounce off this longer term support line. They were only there one day and they're up about 28% on that. And they're going to be down $40 in the morning. They're trading at 660 now, so that'll put them right about their between their 50 and their 21 day. They have a 200 day that's declining. 5-day that's been declining over the past 2 weeks. They have a 21-day that's increasing and crossed above the 50-day moving average. Let's see, that would have been about the 20th of April. They did have a 50-day moving average that was declining. It looks like that has rolled over and moving a bit higher. I did notice that the volume has been pretty much right around the 50-day moving average, and yesterday it was quite a bit less. I think only about 75% of the average daily volume. So that told me that investors were kind of on hold waiting for this report to be announced. And today they traded just right at their 50-day moving average. So they had broken above a 50 RSI on about the 8th of April. They got up to almost oversold and have been declining over the past couple of weeks. They're still in bullish territory at 58. We'll see the chart tomorrow and see if they've dropped below the 50 line, which would put them in bearish territory on the RSI. And the PPO has been looking pretty good. They had a bullish crossover in bearish territory on about the 7th of April. The PPO had been leveling out and coming closer to the signal line. I'm pretty sure tomorrow that we are going to get a bearish signal in bullish territory because I have a feeling that's going to cross below the signal line tomorrow. Okay, so we've looked at 3 of the charts so far. Which one haven't we looked at? Google, maybe. No, we looked at Microsoft. We'll look at Google. They're performing the best of all of these, in my opinion. Last year, they were really struggling. There was fear from the market that they were going to be losing a lot of their search revenue because of AI, but they were lagging a little bit on the AI deployment. But I think they've done a really good job with Gemini over the past few months. I started buying about right here. So I never owned Alphabet before, but I did start buying at this point. We had annotated some downtrend lines or some trend lines. These happen to be downtrend lines. Here was a flat line back to their high in February of 2005 before the first quarter sell-off and then the tariff announcements. And they crossed above all of those. Those were all really positive signs. And I was adding to my holdings here because of the strength that I was seeing in their ability to break above those trends. Then they finally broke above their previous high. And since that point, they are up about 62%. They really never really come and tested this 22-day for months. I mean, they just traded right above that 21-day moving average. This top trend line that they finally broke above, they broke down below that. And if I put my cursor there, that was in February. So they didn't take the same kind of drop as the other companies did on their CapEx plans, but they still took a pretty significant drop, 22% or so. We had a 50-day that was declining. The 200-day never got into a declining condition after. Actually, I think I could have to go back more than a year and a half. It looks like it's been climbing ever since. So this was confirming an uptrend on Google. Their 50-day had been declining, but it is reversed course and moving higher. I have a blended intrinsic value at about $323 on them. That's where I have this blue colored cyan line. So they are trading what I would consider above that intrinsic value, and that means I start getting a bit more cautionary with them. But it does look like they could break out above this trend line once more. That'd be a really bullish signal. We have an RSI that is at 71. We have a PPO that's in bullish territory. We had a bullish crossover in bearish territory on the 2nd of June. Look at this accumulation line. This is a thing of beauty here. I didn't look at that on the other 3 charts, but I don't know if they quite look like that one. So this has been strong for quite a while. Hey, Peyton, good to have you here. Thanks for stopping by. The last thing I think I'm going to go through, unless you guys have any questions or comments. So I'm just going to go through the fast graphs charting. This is a valuation tool that I like really well. They do have that blended PE of 26. They have an EPS yield of 3.75. They do pay a dividend. We're looking at Microsoft here. They do pay a dividend of 0.85%. We're looking at a 13-year time frame, and this is a blended time frame, so it's 10 years in the past, 3 years in the future. They've grown their earnings over this period of time, including the analyst expectations for the next 3 years at 17.98. That gives them a fair value ratio of 17.98. The market normally trades them at a premium, and their normal market multiple, which is the blue line, is 29.02. They are expected to grow their earnings 22% in this fiscal year, which ends in June. Then the next fiscal year, they are expected to grow 15% and 19%. They are trading above their fair value and below their market multiple, which, if we look, they've been trading above the market multiple since 2023. So their challenges with the CapEx and getting Azure to grow at that 38% level, the market, has really discounted them. They are starting to make a little bit of progress. Let me see what they're doing in the aftermarket again. So they're down about 1%. That's not horrible given they had a 7% implied move. So anyway, anytime they're trading above their fair value, I definitely employ some risk management. They have traded above their fair value for 10 years, but I'm always a little more cautionary when I see it above the fair value, and especially if they're trading above both of these measures of value. So let's go take a look at Meta. This is also a 13-year time frame. They have a blended PE of 26.35, an EPS yield of 3.8. They do pay a dividend of 0.31. They've grown their earnings at 25.67. They have a fair value of 25.67 times and a normal market multiple of 29. They are expected to have an earnings contraction. That was for 2025. I'm sorry. Let me move this over one. And let's go back to 13 years because I didn't have 3 full years selected. So they did have a earnings decline in 2025. That's already confirmed. They are expected to have growth of 26% in 2026, 16% in 2027, and 16% in 2028. I think if they can get through this CapEx cycle and turn some of this into revenue because of where they're trading, I think they have a good opportunity for returns over the next 3 years. I've been growing this particular position. Let's see. We want Amazon. So they are trading below their fair value. Let me make sure this is configured correctly. We have 13 years and we're looking 3 years in the future. They have a blended PE of 35.32. They have an EPS yield, not pay. They have an EPS yield of 2.83. 6.5 is considered good value, just as a reference point. They do not pay a dividend over this period and the future estimates. They're expected to grow their earnings 49.44%. They have a fair value of 49.44 times and a normal market multiple of 98. So they also have an opportunity. To me, this puts them at a good value. Not at the best value, but still a good value where you could probably expect positive returns over the next 3 years. So, which one didn't we look at? We looked at Amazon. Okay, we did not look at Google unless my brain cells have died, which is always a possibility. So we're looking at 13 years once more. They have a blended PE of 31.46. They have the EPS yield 3.18. They do have a dividend yield at 0.24. They've grown their earnings 19.86%. They have a fair value at 19.86 times. They have a normal market multiple of 25.64. So the market has applied a premium to this particular name, and they are trading above their normal market multiple and their fair value. So back here would have been the best time to be buying Google when everybody was afraid and scared that Google was going to lose their touch. That would have been the best time to buy. The best time to buy is not today because you're paying pretty significant premium. Although when you go out and look at some of these numbers, you can still expect to have an annual or a gain, a total return of about 15% or 5% annualized. So, okay, I see Samuel Zen is on as well. Good to have you here, man. I appreciate you stopping by. You guys have any final questions or anything else you want to see before we close out? I really appreciate everyone stopping by, and I hope that you found this beneficial. And if you're not subscribed to my channel, I'd appreciate you taking a few moments and subscribing to the channel and pressing the like button. It really does help the channel grow. You guys have already helped me cross above 500 subscribers. That happened this week. So I got to say thank you for those that have subscribed to the channel already. I really appreciate that. So I'll give you a last call here. Okay. Paul, you're welcome. I appreciate you stopping by. Thank you. We'll go ahead and end the stream here. I wish everybody the best in their investment journey. Remember to trade well. We'll be in touch with you soon. Take care. Apples tomorrow, by the way.